Oh boy, this is going to be so much fun! Why? Because now we begin the journey of how to actually value a stock. And guess what? It ain't easy. So it's going to be a rather strange and wondrous and exciting and frustrating journey. Are you ready? I hope so. Chapter 6, Common Stock Valuation. This is a quote from a mutual fund manager with over 35, I guess going on 40 years of experience now. Value matters. You ignore value at your peril. Hey, the man knows what he's talking about, folks, because he's investing other people's money. It's bad enough if you lose your own money. Exactly. Slide number 2, Common Stock Valuation. The process by which the underlying value of a stock is established on the basis of its forecasted risk and return performance. Remember, you can't just look at return. You got to look at risk, too. At any given time, the price of a share of common stocks depends upon investors' expectations about the future behavior of the security. You see, some people will look at the past. No. Good investors look towards the future. A fundamental assertion of finance holds that the value of a stock is based on the present value of its future cash flows. Their earnings. What is the company going to earn? The worth of a company, therefore, is based primarily on the earnings the company will produce in the future. But if we knew what was going to happen in the future, it wouldn't be called the future, would it? Exactly. Does anybody know what's going to happen in the future? No. Indeed. And there's a very famous quote attributed to Niels Bohr, also to Mark Twain, but probably Niels Bohr said it, the physicist. Prediction is difficult, especially about the future. Slide number 3. The most fundamental influence on stock prices is the level and duration of the future growth of earnings and, of course, dividends, which are optional payments of the earnings. However, future earnings growth is not easily estimated, even by market professionals. Now, this is a quote I think you should write and put it up on your board somewhere until you've internalized what Professor Malkiel is saying. Good luck. That's basically what he's saying, because even the professionals can't do it. It makes you think we're going to be able to pull it off. This is from his book, a very famous book, A Random Walk Down Wall Street, which is in the bibliography that's I posted in Chapter 1 and Chapter 5. It's a very good book, folks, and you really should read it. It's one of the first 2 books you should read. One Up on Wall Street by Peter Lynch, and then A Random Walk Down Wall Street by Professor Burton Malkiel, who was involved with Vanguard for many years. Then you're going to read The Intelligent Investor by Benjamin Graham, Warren Buffett's teacher. So if someone were to ask you, maybe on an exam, what is the most important factor in determining the future value of a company? In a few words, you could say future earnings. Or you could alternatively say future dividends. But do any of us know what's going to happen in the future? No. So is valuing stock going to be easy? No. It's not easy. That's why people are paid tremendous sums of money to do it badly. And some are paid tremendous sums of money to do it well. As mutual fund investors, our job is to go find the people who are paid tremendous sums of money to do it well. Slide number 4, security analysis. We've done a little bit of this in Chapter 5 when we took a look at some of the numeric measures, and we're going to now dig much deeper. This is the process of gathering and organizing information and then use it to determine the value of a share of common stock. Because what we're looking for is sometimes called the intrinsic value, the underlying value, the inherent value, as determined through our analysis. The question is, how do you do it? What security analysis methods or measures does one use to determine the intrinsic value of a company? Do we look at future dividends, future capital appreciation, price to earnings ratio? Do we look at financial ratios, past price performance, the amount of risk? Value, as always with any product, is in the eye of the beholder, especially when it comes to an investment. Exactly. The Germans have a saying which doesn't translate well to English, but it really is a good saying if you dig deep into it. That is what makes horse races. Everybody looks at the different horses, and not everybody picks the same horse. Everybody looks at something different, and if it weren't for that fact, there wouldn't be a race. There wouldn't be betting going on the track. I don't know. I like the saying, but it doesn't translate well to English. Slide number 5, fundamental analysis. This is what we're going to do. We've already done a little bit, and we're going to do in chapter 6, fundamental analysis, and then again in our next chapter. And then we'll take a look at the other type of analysis, technical analysis. Fundamental analysis on slide number 5 is the examination of a firm's accounting statements and other financial and economic information to assess the economic value of a company's stock. So we're looking at the company. Some examples of some of the fundamentals. Well, what's the competitive position of the company? Are they one of the most important, largest companies in the industry, or are they a small bit player? Are they jockeying for position in the mid-range? What are the growth prospects for the company and its markets? What are the profit margins? What are the earnings? What assets are available? What is the company's capital structure, which is a fancy way of saying how much debt do they have on their books? How much do they owe? How much do they own of the company? The shareholders' equity, as it's called. Simply put, the value of a stock is influenced by the performance of the company that issued the stock. Now, this makes perfect common sense, and it is the analysis method that I prefer. So I'll tell you right up front. The other major method is called technical analysis, which doesn't look at these things. It looks at squiggles on a screen, and I think they're all wet. But we'll get to those later on, folks. We'll get to those later on. Slides, and of course, there are many people who do a bit of both, right? They use both. Slide number 6, financial ratio analysis. This will be the first one that we will investigate, and we will look at many other financial ratios later on because there are numerous financial ratios. One method of security analysis involves looking at certain financial ratio measures. Financial ratios give us a quick and easy method for comparing one company to other companies within their industry or the stock market as a whole. The problem with financial ratios is that there is no single financial ratio that can adequately sum up or summarize the overall general state of affairs, the situation, the predicament, etc. that the company finds itself in. You can't just look at one financial ratio and say, this is it, this is why I'm going to buy or sell the company. It doesn't work that way. You have to look at all of them. And the first ones we're going to investigate are the price ratios. And we're going to show how we can use the price ratios to badly predict the price of a stock in the near-term future. Yeah. Slide number 7, the price to earnings ratio, the most popular stock market statistic. And we discussed this in chapter 5, and we're going to discuss it throughout the rest of the semester because it is such an important relationship. And as we said, the PE, the price to earnings ratio, gives us a very good indication of what investors believe the prospects for the company are. It doesn't mean they're right, but that's what they believe. They're voting with their dollars. And the higher the PE in general, the riskier the stock, but the more the investors believe that the company's future is bright. The lower the PE in general, the less risky the stock. Why? Because it just doesn't have a price bid up relative to its earnings so high. But at the same time, it's also telling you that investors are not really excited about the prospects for the company. Remember the Google and the GM relationship that we looked at, the situation in Chapter 5 where Google was selling for a very high, in 2005, very high PE, whereas GM was selling with very low PE, but there really wasn't much value in GM because in 2 more years it goes bankrupt. 3 more years it's bankrupt. Exactly. And one student, interesting, said, well, shouldn't we be looking for a company where the PE is 1? And I said, well, yeah, I understand where you're coming from. You're looking for safety. You're looking for less risk. But what does it mean that the PE is 1? It means that people think that this company is about ready to just either the price is going to plummet or the company's going to go bankrupt. So we have to gain an appreciation, which is hard to measure, right? I apologize to those of you who are into educational technology and objectives. We need to gain an appreciation, a subtle appreciation of the relationship, the eternal tug of war of the high PE versus low PE. In many ways, it mirrors back to our discussion of risk versus return. And here we have some examples. And these are companies that just happen to begin with the letter G, folks. That's their only relationship to one another. So it's not as though I try to link these all together. We've got GM, General Motors, GD, General Dynamics, GE, General Electric, Google, and then, which is now called, by the way, Alphabet, GoPro, GoPro, not Go Broke. And so let's take a look at their PEs, right? Let's take a look at their PEs. Bingo. Up. Come on, let's do it. Bunk. Hit the wrong button. My apologies. There we go. We're looking at, as of September 28, 2016, and we see that GE is a PE of 4. 4? It's close to what that one student wanted, isn't it? What are investors thinking about the prospects for GM? Let me look at Ford, too. Go look at Ford. You know, we're going to talk about cyclical. We already did. We talked about cyclical companies. A lot of people believe that we're heading for a recession soon, and so the cyclical companies have been bid down. Their prices have been bid down. I don't necessarily agree, but doesn't mean I'm right. Doesn't mean I'm wrong. We'll see. When the next recession hits, we'll know 6 to 8 months after it. General Dynamics has a PE of 16.6, which is, fairly middling. That's average. What are the prospects for this very large, venerable defense firm? Well, if you're involved in politics and world economics and world politics, you might be more inclined to say, things are fairly stable, even though we hear quite a bit about certain conflicts around the world, but at least the superpowers aren't duking it out anywhere. At least they aren't now. How about General Electric, 25, and Google, 25.8? Yes, investors are saying with their dollars that they believe that GE and Google's prospects are pretty darn good because they have a PE that's higher than 20. What happens if it doesn't pan out? Exactly. That price is going to fall. Relative to the earnings, the PE will come down. And then GoPro. Yes, if you are at all inclined to watch what is often referred to as a hot issue, a hot stock, follow GoPro and take a look at its recent history over the last, several years. And you will see here is an archetypal, high growth, buzz related, everyone's talking about it, company whose stock price just skyrocketed and then plummeted and then skyrocketed and plummeted. And the PE is not applicable. Well, it's really, whenever a company is losing money, their earnings are negative, they usually put NA, not applicable, for PE. It's not true. It's a negative number, and you can compute it. It just comes out negative. So they basically say, look, don't look at the PE because the company's losing money. So what do you think? What do you think the prospects for these companies are? Do you agree with investors or do you disagree with investors? Well, we'll know in 3 to 5 years. But it's too late then, right? Okay. Historically, as we said in Chapter 5, a company's PE was supposed to match its growth rate. If the company was growing at 20%, then a PE of 20 was justified. During the internet bubble, many companies had PE ratios in the hundreds. And I will never forget looking down at the computer screen and seeing eBay's PE of 10,000. It's nuts, right? It was, and I'm thinking to myself, this isn't going to last. I didn't know when it was going to go down, but it did, and along with all the others, but it survived. Most of the other internet companies did not survive, but I just knew this ain't going to last. As we said, the growth stocks typically have high PEs, value stocks typically have low PEs, but remember our discussion of growth versus value. A value stock might not necessarily be a good value, depending on how we define value. I define value as something that's worthwhile, something that is of my interest, that may help me achieve my financial goals and make me wealthier. Not just because it has a low PE. The PE ratio tells you how long it will take in years, assuming no changes in earnings, which they're changing all the time, for the company to earn back its price. Now, some people say, well, should we be worried about that? I said, no, it's just a gauge of how long it will take companies to earn back their price. A PE takes 3 years. A PE of 3 will take 3 years. A PE of 20 will take 20 years. A PE of 10,000 means that they will have to worry about the Y10K problem. So we had to worry about the Y2K, but we should start planning for Y10K when it goes from 9,999 to... No, don't. Forget about it. Slide number 9. So how can we use... we're getting ahead of myself. I'm sorry. Price to cash flow. So we looked at price to earnings, right? Now we're going to take a look at price to cash flow. It's basically the same idea, except we look at the cash flow instead of the earnings. And you may say, well, Payano, how can they be any different? The cash coming into the company is the earnings, right? No. Especially if you've taken accounting, you know that for several reasons, cash flow often differs from earnings per share. And one of the main reasons is depreciation. When you take accounting, you will learn that depreciation is an expense in the accounting world, but nobody writes a check to depreciation. That cash does not flow out of your checking account. So that is part of the cash that came into your company, even though it reduced your earnings. And why would you want it to reduce your earnings? Because you pay fewer tax dollars then. So you'll hear people talk about good quality earnings and poor quality earnings. And it's the same formula. Instead of price divided by earnings, you divide price by cash flow per share. So you just substitute cash flow per share for earnings per share. And when we say poor quality earnings, what are we talking about? Well, a good example of this was happening a bad example of this, I should say, was happening during the internet mania. Many companies were reporting record earnings, but at the same time, their cash flow was negative. Their checkbook was going down. And you said, well, how can that be? It doesn't make any sense. Well, one company that went through a near-death experience was Lucent Technologies. Now, who are they? They used to be Bell Labs and Western Electric. They used to be the equipment arm of the monolith AT&T. This was many years ago, folks. And when AT&T spun off the baby Bells, they eventually then spun off Western Electric and the Bell Labs into a company called Lucent Technologies. Now, Lucent Technologies made the best, and they probably still make the best telephone equipment in the world. Okay? No argument there. And maybe now, it's all changed because they merged with Alcatel, and now they're being bought, I think, by Nokia. So it's, everything's changed. But at the time, they were the best. And they were selling tons of telecommunication equipment at the end of throughout the 1990s because of the internet, because of cell phones. And many of these companies were startup companies with, not a whole lot of cash. So they would go to Lucent Technologies and they say, "Hey, we're WinStar. I can't remember the name of some of the other ones. That was one of the big ones that crashed and burned. We want to buy $2 billion worth of equipment, but you know what? No bank will lend us the money, and we don't have $2 billion. Will you sell us the equipment, and then we'll pay you $100 million a year for the next 30 years or whatever?" And Lucent said, "Great. Yeah, we'll do it. We get to sell $2 billion of equipment, book it as a earning, as a sale. We don't get the cash, but now we're going to get cash for the next 30." No, they maybe got a few payments, but then the company promptly went out of business. And Lucent is stuck with $2 billion of equipment that they don't want, they don't need, and it's already obsolete, and they can't sell it to anybody. Exactly. So you have to be careful. Good quality earnings, poor quality earnings. They did survive, by the way, but it was almost not. I remember the stock went from $80 down to 80 cents. Yeah, I think that's what happened, as I remember. Slide number 10, price to sales ratio. Same idea, folks, but instead of looking at earnings or cash flow, we now look at the sales per share. Historically, just like a higher PE or a higher cash flow per share a higher price to sales, just as a higher P. Let me start again, excuse me. Historically, a higher price to sales ratio suggested a higher sales growth, just as a higher price to earnings ratio or a higher price to cash flow ratio suggests a higher sales growth. And on the other side, lower price to sales ratio suggested a lower sales growth. Lower price to earnings ratio suggested, the future's not that bright. Same thing was price to cash flow. And so it's the same formula. And again, during the internet mania, many analysts were using price to sales instead of price to cash flow or price to earnings, since most of the all new companies weren't generating any earnings. And it didn't look like they were going to generate any earnings for several years. So look at their price to sales instead. Okay. Price to book ratio. Same idea, take the price, but now divided by the book value. And the book value, as we talked about, is an accounting number. It doesn't necessarily mean that's what the assets are worth on the books. Even though they're on the books, that's what they're worth. Doesn't mean if you tried to sell them, you would get that. But the price to book ratio takes the price and divides it by the current book value per share, which again is as I said, is an accounting number. You have to talk to the accountants. The book value of the stock is the value of the assets the company possesses. So if you were to sell off all the assets, pay off all the debts, theoretically, this is what you would have in your pocket. Historically, companies wanted to have a price-to-book ratio, or at least investors wanted companies to have a price-to-book ratio that was, close to 1, because if the company went bankrupt, then theoretically you could at least get your money back. It never works that way in reality. When a company goes bankrupt, usually the assets are sold off at a much lower rate than what they're actually worth. But over years, people realized that, this doesn't make sense. A higher price to book ratio makes sense because the company is worth more intact than if we broke it up and sold off all the assets and paid off all the debts. Now, there are times when a company's assets become worth more than what the company is selling for in the market because investors are terrified about the future for the company. And when that happens, it's a very dangerous situation. Corporate raiders, takeover artists, private equity firms that go by various names can come in and buy up 50% plus one share and then liquidate the company and sell off all the assets. And in their case, hopefully, if they're lucky, they walk away with more money in their pocket than what they paid for the company. How do you feel about being an employee that you've worked for 20 years and now the company's out of business because this corporate raider from wherever, New York or Tokyo or wherever, decided to liquidate your company? And so people get angry and they call their elected representatives and they say, this isn't fair, this isn't right, this should not be allowed. And the economists and the corporate raiders, if they were so inclined to talk to you, would tell you, you don't understand. We need this to happen. We need capital to be unlocked and plowed under and then reissued and reemployed in a better method. That those assets were not being utilized to the best interest of the society. Which is all well and good, but now I'm out of a job. So that's why we have unemployment insurance, folks. It's not to pay people not to work. It's to encourage that capital to be reemployed in more effective, more efficient manners. And at the same time, keep people from starving until they find another job in an enterprise that is better suited to moving our collective needle forward, moving our society forward. Does that make any sense? Think about it and scream and holler at the people who are unemployed. Okay, slide number 12. Okay, how do we use these things to predict the future? Well, it's actually easier to do than it is to explain. And we're going to do it several times, and I'm going to explain it to the best of my ability. But I really, if you're confused, I really strongly suggest that you just do it. And then after you do it, you go, oh, that was easy. And then, yeah, because it's not hard. It's really not hard. It's harder to understand than it is to do, if that makes any sense. To predict a future stock price using the price ratios, what we do is we multiply a historical price ratio by the expected future value price ratio denominator. What? Huh? What are you talking about, Piana? Well, here, let's take a look at Intel. And this is from the 7th edition, but they do this in the 4th and the 5th and the 6th and the 7th. So they're all close to that same page. So just look at them, and it's the same idea. The numbers are different, but it's the same idea. And they always use Intel, thankfully. So in mid-2012, when the 7th edition was created, Intel was selling for $26.98. And the earnings per share in mid-2012 were $2.31. Now, you go back 5 years and you find that the average PE for Intel was 17.1. Okay? That's historical data. We go back 5 years and find the average PE. And we read in the news, we listen to the analysts, maybe Intel gives us some guidance, and they say, look, we expect our earnings per share to go up 7.6% next year. Okay, so with that information, how can we predict the price? Well, what we do is we take the historical PE ratio and we multiply it times the projected earnings per share. So we take a look, what was the PE ratio for the last 5 years, and we multiply that by what we believe the earnings per share are going to be next year. And so you take the historical PE ratio, 17.1, you multiply that by the current earnings per share, $2.31, and then you multiply that times 1 plus the expected earnings per share growth rate. 100% plus 7.6%, which in our calculator would be 1.076. And you get $42.50. So right now the stock is selling for about $27, and we expect, if everything happens the way we believe it's going to happen, that the price is going to be $42.50. Now, if you are thoroughly confused, stop, go back and rewind it, and do the calculation with your calculator. And you'll see that it's actually very straightforward. We're taking the historical PE and we're multiplying by what we believe the earnings per share is going to be next year by taking the current PE and then 1 plus the 7.6% that they tell us their earnings are going to grow by. We don't know that yet because it's still a year before that earnings per share is going to be announced. Now, look at number 13, slide number 13. Same calculation. The only thing different is we now use price to cash flow. So again, the price is still $27. That doesn't change. The cash flow per share was $3.65. Now, why is that? Well, because of depreciation. Intel is a capital-intensive company. What does that mean? It means they have to do a whole lot of research and development. They have to put out a whole lot of bucks before they can make the first chip. So it cost them $2 billion to make the first chip. Then it cost them $2 to make every other chip. And that upfront cost has to be depreciated. You can't expense it all in 1 year. Talk to the accountants. Don't believe me. I took accounting 1,000,000 years ago, and after I left that class, I said, I ain't never doing this again unless somebody pays me a whole lot of money, and nobody ever offered me, and I never did it. Anyway, so the cash flow per share is higher than the earnings per share, which makes sense in a company like Intel, which is very capital intensive. Their average price to cash flow over the last 5 years, historical data again, is 8.00 price to cash flow. And the analysts, we doing our research believe that next year the growth rate for the cash flow will be 7%. So we do the exact same calculation. We take the historical price to cash flow ratio from the last 5 years and we multiply it by what we believe the cash flow per share will be in 1 year. So we take the historical price to cash flow ratio, 8.00, multiply it by this year's price to cash flow, $3.65, $3.65, and then multiply that times 1 plus 7%. 100% plus 7%, 1.07. Do it. Stop the presentation. Do it again when you're calculating. You'll see that's what we come out with, $31.24. Well, this is very far from what the price to earnings estimate was. It's much less. What's going on? I don't know. Last one, price to sales. Same exact calculation, folks, but using the price to sales data. And our mid-2012 sales per share was $9.99. The average, 5-year average of the price to sales ratio was 3.00. And the analysts, Intel, maybe gives us a little bit of what is called guidance, is that their sales are going to grow 4.5%. So we do the exact same calculation. We take the historical price to sales ratio times the projected sales per share, which is the historical price to sales ratio, 3.00, times this year's sales per share, $9.99, times 1 plus 4.5%, 1.045, and we get $31.32. Now, this is much closer to that price to cash flow prediction. So we went through that fairly quickly. Why? Because it is quick. Once you do it a couple of times, you'll go, oh, and then maybe you'll go back and understand what the hell you did. Pardon my French. Because when you're doing it, you kind of go, I don't understand. And then you go back and say, oh, I'm just saying to myself that if the earnings, cash flow, or sales, and or all increase by the level I believe they're going to increase, and the average PE stays what it was for the last 5 years, then this is what the price is going to do next year. It's that simple. And for that reason, it's pretty stupid. Slide 15. Reality check. Can we reasonably assume that the formulas on the previous slides will give us realistic figures? Well, for many companies, yes, and for many companies, no. There are countless other factors at work. It's like trying to predict the weather. only worse. The major assumption of these models is that the price multiples will remain constant. Let's say that again. The major assumption of these models is that the price multiples will remain constant. However, we are using a 5-year average without taking into account the variances and the standard deviations of the average. Remember them? Yeah. Is it reasonable to expect predictions from these models to be accurate if the variances of the averages are large? No, because you don't know what the price to sales ratio, the price to cash flow ratio, the price to earnings ratio are going to be next year. That depends on what investors' expectations are for the future. It's not a static number. It doesn't stay constant. Slide number 16. For the record, the price of Intel 1 year later in mid-2003 was around $24. Yes, it went down, not up. Not so good, eh? Check out the previous editions from the 3rd, 4th, 5th, and 6th, and the only predictions that were anywhere close to the actual prices were from the 6th edition. Yeah, doesn't give you much confidence in the price models, does it? No. But take heart, dear students. The predictions for Disney, for example, from the book were much closer to the actual prices. What's the moral of the story? If it's a company that has average PE, average price to cash flow, average price to sales, with a huge standard deviation, a big variance, then forget about it. It's worthless. It's an academic exercise at best. But if it's a company that's much more stable, that tends to not have a huge variation in their price ratios, then it is much more effective. And it is just one tool. If you're reading through the book, you'll notice that this is actually near the end of the chapter. And the reason I did that is because, first of all, these are a little easier. And also, I wanted to save the best for last because, dear students, in the next 2 presentations, we are going to learn valuation techniques that I believe personally, in my personal opinion, are awesome and will do well toward tilting the odds in your favor. As we've said, we're just blowing it. We're just putting our finger up in the wind and seeing which way the wind blows. We're just we're just coming up with numbers that we don't believe ourselves are going to be actually what is the price in a certain amount of time. But by doing these calculations, we tilt the odds in our favor. Okay, so when we come back, make sure you do these. Now, there's 2 worksheets. There's 2 worksheets that you want to work on. And the first 3 problems are this exact type of problems that we just did. They're in the exact order. And then the assignment is in the exact order. You getting the feeling? I want you to do these over and over and over again until you look at them and go, oh yeah, I know what to do with this. We will see you in our next presentation when we discuss the dividend discount models. Oh boy, are we going to have fun! See ya!